address all of our questions at the end of this. We'd like to thank Connor and BlackRock for jumping in on this again. It's very interesting. They hosted our first one last year, and a lot of the things we discussed have actually come to fruition now. So this is going to be a very interesting follow-up and a kickoff into what we see coming up for the year. Again, as a reminder, these aren't political webinars or religious webinars. It's more so just analytically looking at what we see ahead, where we believe the opportunities will be for clients, and where we feel there may be risks that aren't being accounted for at this time. So without further ado, I'd like to say, Connor, take it away and let's hear what we've got coming up for the year.
Awesome. Well, thank you so much, Chris, and thanks to everyone for joining us today. It's good to be in front of you again. I know I see some familiar names from the webinar last year, and hopefully you found some value in those thoughts as well, too. Again, as Chris mentioned, my name is Connor McCrory. Really glad to be with you today. Also, for the last 9 years, I've been pretty proud to work for the investment firm BlackRock, and I spend my time partnering with great advisor teams like Chris and the Signet Wealth Group, and we assist on a number of different things. And one of my favorite things to do is forums like this that once upon a time we did in person, and now they've obviously moved to all virtual for good reason. But as Chris mentioned, there's certainly a lot of topics that we can talk about and talk through today. Markets, in our opinion, are in an incredibly unique place after the events of 2020, and that has a major impact, in our opinion, on what the future holds for us. And we look forward to diving into that for the next 30 minutes or so. But really what we truly aim to do is just give some more confidence and address some concerns. BlackRock, in my opinion, has done its very best to try to boil down all the noise that you're constantly inundated with, which there's tons of it, and condense that down into what we think are the really important topics that deserve your attention when it comes to your portfolios and the way you invest your money. So before we really dive into the future, we always find it particularly important just to provide a quick review to set the grounds for what has already happened in 2020. And 2020 was obviously a bit of a whirlwind. There was so much that happened last year. It can be pretty hard to remember the details, but if you rewound the clocks back 12 months from today, we were starting to hear rumors and rumblings about something called the coronavirus coming out of China. We didn't know much about it. We didn't know how it was going to affect us. And many of the smartest folks in the country actually dismissed it as a very serious matter. Market headlines, if you were to turn on the TV last year, were focused on the UK leaving the European Union, impeachment proceedings, and Bernie Sanders and Elizabeth Warren at this time last year were likely the front runners to be the Democratic nominee. Since then, I think we can all chuckle at that. Things have obviously changed a bit. Actually, February 18th of last year is when the markets peaked, which is exactly a year ago from today. From that point until right around mid-March to late March, we saw a pretty steady decline in U.S. equity markets and markets across the globe. And from top to bottom, we saw the S&P lose about 34% of its value from their highs. And just as quickly as that happened, central banks around the world announced huge measures to support their economies. The Federal Reserve in the United States was no exception. We have remained committed to keeping interest rates at near zero levels for the foreseeable future, which we'll talk about here in just a minute. And the levels of stimulus have been pretty massive, and they've dwarfed levels of stimulus that our country has seen even through time periods like 2008 and the financial crisis. In our view, there's more stimulus ahead. And really what that was aimed to do last year was basically put everything on freeze until the economy was ready to be reheated, which we think we're getting closer to. And a lot has happened since that point as well, too. In the last 6 months, we've all been living through a pretty unprecedented health crisis. Millions of people have unfortunately caught this virus. We've had a historic election, and markets in large part, led by large cap stocks and technology stocks, have roared back and defied expectations. Maybe most importantly to that, we've received multiple coronavirus vaccines, both with over 90% efficacy, and the deployment of those vaccines is now underway in our country, as we all know. And that's a lot. That's a lot to think about. It's kind of exhausting just to talk through it. But the big question, in our opinion, is what happens now and where do we go from here? And if you think about where we are today, we still think that we're in most parts of the country, a pretty dark and trying winter time period, especially from a health standpoint. And many parts of our country, that presents a major risk to the resurgence of the pandemic. Fortunately, the numbers are coming down. However, markets being inherently forward-looking are pretty quickly moving beyond the present time period and looking into brighter times ahead. Last year, we stated that the coronavirus on this very call was much like a natural disaster. We equated it to something like, a hurricane or a major flood in a region, or wildfires in California specifically, where the market impact was incredibly quick and swift and pretty dramatic. But once the initial storm was over, we would see and have seen a pretty quick recovery as well too. The challenging part is that investors that couldn't handle the storm last March missed out on some pretty historic rally numbers, and that's okay. But what this graph aims to do is just give you an idea or put into perspective what the potential setback of the coronavirus is on the actual economy, and more importantly, put it in comparison to a previous financial crisis that we faced in 2008. And as you can see in green here, 2008 and the global financial crisis set off what we would call really an unraveling of our economic system. And that loss as a percentage of GDP, as you can see, was much, much deeper than what we saw over the last 12 to 18 months in our economy as well too. Most importantly, because in our opinion, the COVID-19 crisis didn't come from an economic problem. And importantly as well too, it was further dampened, or the amount of pain we felt in the country was actually dampened pretty quickly by a really aggressive central bank policy, which is good news. And we think if you look at this chart, the good news in our opinion is actually twofold. One, the economic pain, as you see in the orange by all estimates, is pretty much leveling off in our opinion. And we would say almost certainly that the worst is over, which is great. And then two, from an economic perspective, there's really almost no comparison between what we have faced in the last 12 months from an economic standpoint versus what we faced in 2008. And all of those things, in our opinion, are really good signs for investors. And now that we're moving into 2021, this to us are really the four themes that we find to be the most critical and quite frankly worth your attention for the foreseeable future. And when we say foreseeable future, that's not the next couple of weeks or months. That's really for the next 2 to 3 years, in our opinion. One is probably the most obvious. It's, of course, the path of the virus and the deployment of the vaccines. We'll talk a bit about that. Two, one of the big challenges, or you can even call it a problem, that formulated after last year is that interest rates collapsed. And now all of us as investors have to deal with what we would call this low rate problem within bond allocations. The third one, as you see on the screen here, is really just the current stance of what we would call globalization and how that has changed after COVID-19. And then lastly, what really gets us excited is number 4, which again is likely the most exciting thing that we'll talk about today, but really what has changed after the pandemic, or what we would call turbocharged transformations, the trends that have been accelerated as a result of the coronavirus pandemic. And as Chris mentioned earlier, where is there massive opportunity for us as investors? A lot of that, Chris and his team at Signet Wealth are already tapping into, which is great news. And then first, to start with us here, if you start to think through, the outlook for the virus, we have always said that this is likely the most important factor in regards to how quickly our economy can get restarted, for lack of a better word. The path of the virus and the path of these vaccines is a really critical thing to focus on. And fortunately, it's a lot of good news at this point in time. So what you're looking at, and this can be a little bit of a busy chart, but I'll try to demystify it. The green line here shows you at these points in the past, historically across the bottom, what was the probability that we had 25 million people approved and able to get the vaccine sometime after April 1st of 2022. So basically it's bad case scenario. What was the probability that a bad thing would happen? And at this time, or I should say as of May last year, that was almost a 50-50 chance, which at that point in time was a pretty terrifying number to hear. That basically tells us that there was a 50-50 chance that we were going to get vaccines out to people no earlier than April 1st of 2022. That was pretty challenging, and that's one of the reasons that markets were so volatile in the first half of last year. As you can see, that green number has basically come down to zero towards the end of last year, which is great news. And now what you're seeing instead, as after some pretty unbelievable measures from scientists and really our economy as well too, the orange line is starting to really peak here in the last couple of months. And that's basically telling you the opposite, or what's the probability that good news would happen from a vaccine rollout standpoint. And you can see it during September and even October of last year, there was almost a 60% chance that we would get 25 million people vaccinated at some point during October of last year to March of this year. And we have already blown through those numbers, which is all good news from our standpoint. And the beautiful part about that is, as more people receive the vaccine, our economy, in our opinion, can start to function properly again. And this graph is showing you quite simply what is the path of GDP. And you can see we were on a pretty good trajectory coming into 2020. And of course, the coronavirus pandemic threw a little bit of wrench in those gears, and we saw a pretty big decline in GDP. But the good news from here is that we've already kind of been through this V-shaped recovery. And even if you factor in the winter lockdowns and some of the challenges in the central part of the country with extreme weather at this point in time, we are still on a really good path from our standpoint to return to somewhat of a normal level in the very near future, meaning within the next 12 months. We do, and we probably would offer a warning to that as well too. There is still some pain in the economy that the vaccine does not solve. And implementation of the vaccine rollout is still ongoing. And even after people get it, it doesn't mean that the virus goes away. The current market is obviously reflecting some optimism over the past couple of months, and really over the past 6 to 8 months. But the past couple of weeks are a good example that we should all be expecting volatility in our portfolios, both upside and downside, over the coming months. And as more uncertainty happens, which we think there's more certainty on the horizon than uncertainty, but as uncertainty does start to formulate itself, that's how the last couple of weeks tend to happen, which is a little bit of volatility in the equity markets. And that to us is just very normal as a part of any recovery that we've ever faced in history. So again, we expect a positive path, but let's all be prepared for, in our opinion, what we would call some bumps in the road from just a market standpoint alone. People ask us all the time, you know, how did markets do so well last year amidst all the chaos? The S&P 500 last year returned north of 16%. The bond market, if you measure it by the Barclays aggregate, returned right around 8%. On a surface level, it was a pretty banner year for almost every asset class. There's a bunch of reasons why that happened, but one of the big ones, in our opinion, is really what central banks did with stimulus and interest rates. In order to stimulate the economy, the Federal Reserve put a ton of money into the system, and they also brought rates basically down to zero, likely for the foreseeable future, which means, again, probably for 1 to 3 years, rates will be very, very low. And that worked really great last year. Bonds provided you that meaningful hedge in portfolios. They also had a decent amount of yield, not a great amount of yield coming into last year, but you earned some decent yield on those as well too. And that diversification story of why we even own bonds really, really formulated itself last year. The challenge, in our opinion, is what do we do now? And as a bond investor, your returns on that specific part of your portfolio typically track how much yield you receive or how much your interest rate is. And this is a trend that is almost without fail back to the 1930s, as you see on this chart. basically where interest rates start that decade is typically what bond returns look like for the next 5 to 10 years. And if you think about it this way, there's a huge spike in this chart in the 1980s. If you rewound the clocks to start 1980 on a 10-year treasury bond, investors were actually getting 12% from a yield standpoint. I think everybody would sign up for that today, because if you think about what a 10-year bond is today, it's actually sitting right around 1.2%. So it's no secret that bond returns in that time period were obviously much, much more attractive. Today, we think it's a little bit more of a challenging picture from a return standpoint alone, and that's one of the big things that formulated itself after last year, is that bonds are no longer as attractive from a return standpoint as they once were. That does not mean, in our opinion, you just abandon all of your bond holdings. From a risk standpoint, bonds still play a huge part in portfolios for downside protection, but if you're looking for yield and looking for higher returns in bonds, we all have to think a little bit differently about how we get to those points, and are we comfortable with taking more risk in order to get those yield levels, which whole another conversation, and we can certainly dive into that towards the end of this if you'd like to. The third thing that we're watching really closely is what we would call kind of a rewired globe from our standpoint, specifically when you start to think about how the U.S. is really engaging with countries overseas, most specifically China. What this graph is really trying to illustrate is the huge ground that China has really gained on the rest of the world from a GDP or a gross domestic product standpoint over the last, call it, 2 decades. It's actually showing you that currently in the yellow line here, China is actually a larger share of economic growth and economic GDP than the United States, Japan, and Europe combined. And the orange line is actually showing you the share of the US, Europe, and Japan. The yellow is, of course, basically China. Again, China is actually now, from an economic standpoint, a larger share of GDP than those 3 major regions combined. And that to us is a huge deal that we all need to focus on as investors. It presents challenges, as it's pretty unlikely that US and China, these 2 massive powerhouses, are all of a sudden going to get along perfectly well. I would say our current administration is a bit more globally friendly than our previous one, but the consensus, whether you have a Republican mind or a Democratic mind in the White House, is that the posture that the U.S. takes in regards to our relationship with China needs to be rethought, and it needs to be a little bit more strict than it has been historically. This matters to us because it provides a pretty major threat in this massive web of what we would call global supply chains. It could potentially lead to some pretty major onshoring of the U.S. production efforts, less of that stuff being outsourced overseas and more stuff brought into the U.S.'s borders, which is great for jobs. It can make goods a bit more expensive from our standpoint, but the leadership in production and technology enhancement specifically will be really important factors from our standpoint into how these 2 economies and all economies start to interact with one another going forward. We are already starting to see the effects of this in the global trade picture. And this chart basically shows you the trend in terms of, in black is kind of the historic trend from a global trade standpoint. In orange there, you're starting to see what the actual global trade as a percentage share of a country's GDP actually has been. And basically the moral of the story is you're starting to see that level off as globalization comes a little bit more challenge to us under this type of environment. What that actually means for our portfolios, in our opinion, is we need to start thinking a little bit more about what we would call global diversification, looking overseas to emerging markets, some international developed countries as well too, as potential growth opportunities for us. I think we've all probably had a pretty major U.S. bias for the past 4 or 5 years. It's worked out great in portfolios. Now might be the time, in our opinion, to start to think about how do the overseas market look from an opportunity standpoint, as they're starting to operate much, much differently and a little bit more independent of the United States, in our opinion. The last theme here really quickly, which we'll dive a little bit deeper into, we want to define a little bit further as to what we call turbocharged transformations. And many are already observing the signs of this, as in 2020, there were pretty big winners during the recovery. And there were also companies that just simply could not adapt quick enough. And there was also some pretty big losers, unfortunately, from a sector standpoint and from an industry standpoint in general. This graph shows a great example, one that I think we all know, but just to show you how stark the differences are, I think it's pretty eye-opening. Consumer consumption patterns are changing, and they're changing quicker than I think people realize. And importantly, COVID-19, amongst other things, has accelerated that change. E-commerce to us and technology has exploded. Brick and mortar retails have, of course, struggled. This to us is not a short-term blow because the economy is shut down in most parts of the country. This is part of a larger trend that we think will not only continue, is actually happening faster than we anticipated, if we were to have this conversation 2 or 3 years ago. And COVID-19 is to either blame or credit, depending on how you look at it. Technology is accelerating these adoptions. In our opinion, the technology sector is likely to remain its strength as the strongest sector within the market for the foreseeable future. And we see potential for leadership within that technology sector. You think about areas like 5G technology, remote and virtual work flexibility, and even automation are areas that, in our opinion, are likely to explode in the next couple of years. Companies are constantly looking for, especially now, ways to become more efficient, more virtually friendly for their employees and their business models, and even just lower their costs across the board in general. Technology is going to, of course, reap the benefits from that major shift in the way businesses conduct themselves going forward. Healthcare to us, which is not on this chart, is another long-term trend that's just only gotten accelerated after last year. The demographics in the United States are older than they've ever been, and they're just getting older. In the very near-term future, within the next year or so, we will have more citizens in the U.S. that are over 65 than we have under 18. And in the U.S., we will be spending about $2 trillion more in healthcare per year than we did just about 2 or 3 years ago. An older population to us means more healthcare needs, and coming off the back of a major market pandemic, that means more spending on what we would call preventative healthcare measures going forward. And those provide huge tailwinds for the healthcare sector that likely have not been realized at this point in time in actual portfolios. The last one to us, I want to leave some time for this one, is, in our opinion, the biggest. And it's not a sector like technology or healthcare. It's more of a way of thinking and analyzing companies, which I know Chris and the Signet Wealth Group are already huge believers in. But the accelerated trend of sustainable investing is really here to stay. And BlackRock is arguably one of the biggest believers in this in our industry. It's becoming a bigger part of the way that individuals look at companies. It's becoming a bigger part in the way that the smartest pensions and endowments build their portfolios as well too. And it should be a bigger part in the way we analyze our portfolios going forward. What sustainability is, and I would imagine that a lot of people know this working with Chris and the Signet Wealth Group, it's an added lens that we can all use now to understand how a company conducts itself from an environmental, a social, and a governance standpoint. That's what ESG stands for. It does not throw away historical metrics like price to earnings or cash flow, but it simply adds additional ones that we can use in combination to complement more what we would call a fundamental analysis of a company. But really what it's designed to do is help understand the sustainability of that business model and the future path of that company and how sustainable their future growth will actually be, all things considered. this to us, and Chris mentioned this on the upfront, sustainability or ESG or socially responsible investing is not a political stance. BlackRock does not have a political axe to grind. We are in the business of making the most amount of money for our end investors. ESG, in our opinion, aside from other reasons, is the way to do that. Really what ESG and sustainable is designed to do is just be a more thoughtful way to understand what are we investing in, how do we drive performance, and are these companies operating in a more sustainable business model going forward. So if we unpack that just a little bit further before I open it up for any questions or thoughts or concerns that you all have, let's just kind of break apart what that ESG means to us and why it's such a huge trend going forward. The E, as you can guess, it's all about environmental reasons. The pandemic has proven to us that markets have really not priced in and really can't price in extreme events. You think about last year, even a year and a half ago at this point in time, wildfires in California. Markets can't really price that in, but it has a major economic impact on companies and municipalities. I could go on and on about that. But as we transition to a more sustainable world, markets, in our opinion, are really underappreciating the potential economic damage caused by climate change. And again, you've seen the negative effects of things like this. You think about hurricanes like Hurricane Katrina in New Orleans, the wildfires again in our part of the country, and you're even seeing it now. The severe winter weather in the middle part of the country right now is basically showing that some of these places are unprepared for climate change. And I can promise you that Texas is going to feel some of these economic effects going forward, as they're just not a place that's really prepared to adapt to extreme cold weather. These are just some examples. We think that that trend is accelerating, and the environmental stance that these companies take, in our opinion, to prevent things like this and prevent climate change in general will be a huge, huge part of how much assets get invested in these companies, in our opinion. So again, those environmental reasons have some pretty major costs, but there are also related opportunities like renewable and clean energy, just to name a few. The S in ESG captures social issues. This is a bit more self-explanatory, but they've garnered some huge attention over the last year or so. Issues like employee safety in the middle of a pandemic are obviously top of mind. Employee satisfaction scores actually have a major effect on how a company does over the long term. So again, these are things that you wouldn't really find on a company's balance sheet, but if we screen for these, and there's a bunch of ways to do that, it actually gives us a better idea of the future prospects for these companies as well too. And the last thing of this ESG conversation is G, or the governance. Governance has always been an important consideration for many investors. It's becoming increasingly apparent to us that good leadership and sound governance in a company leads to and is pretty critical for long-term success. I think that one's probably the most self-explanatory. But as you can see here, this matters not only from a do-good type of feeling, meaning that we feel good about who we invest in. It also matters from a do-well type of mindset when it comes to how your portfolio actually responds and the account value over longer periods of time. Companies are now really tied to these ESG screening metrics, and every company, quite frankly, gets a score. Are they a leader from an ESG standpoint? Are they average, kind of middle of the pack? Or are they more of a laggard, yet to adapt to these type of reasons? And as you can see in this chart here in the green, companies that lead in this space perform better. Companies that lag in these areas, like the triple C or the B type ones in pink there, they just frankly perform worse over longer periods of time. It seems obvious having this conversation now after the last 12 months, but in our opinion, this trend is only starting, and we actually now use it as a core part of every BlackRock investment that we put together. And it's a huge part of the investment process, of course, with Chris and the group at Signet Wealth as well too. So maybe I'll just pause there for a moment. I know that is a ton of information. I'll just rewind it right here really quickly just to provide maybe the important points to take away. Of course, we know, number one here, the virus and the vaccine, The path of both of these are really critical. And while we're optimistic, we should all expect some volatility from this standpoint, as well as markets in general. Maybe the biggest challenge after last year is what we would call this low rate problem. Bond returns are coming down. There's no question about that. And if you're an investor that's more yield hungry or yield oriented, we have to start to think a little bit differently about how we earn our yield in portfolios. And then the third one here is that the world is changing. It's changing really quickly. We have to become, in our opinion, a bit more global in our thinking, and having this massive, massive overweight to the United States simply isn't going to cut it going forward. And then the last one, which again is the most exciting to us, is where should we have some strategic tilts in our portfolios or with our money? And in order to grow and seek returns that are outsized over the markets, technology, healthcare, and more broadly speaking, ESG and sustainable characteristics are the places that BlackRock feels very strongly that we want to have some strategic tilts towards across our investments as well too. So with that, let me just pause there for a couple of minutes. Again, I want to thank everybody for listening and dialing in, but I hope that helps boil down some of the noise. I'm happy to stick around as long as you guys need us for more questions. And with that, maybe I'll turn it back to Chris to facilitate some of that question asking.
Sure. Thanks, Connor. Can you hear me, Connor?
I can hear you great.
Great. I wasn't able to redo the video, but just in general, there's a couple of things you brought up which I think are important for people to really kind of understand, because what last year showed most people, not only in our industry, but for clients in the world in general, is that sometimes markets don't work the way the rest of the world works. And it was very amazing for a lot of people to see the markets not only bottom, but rebound the way they did. When you look around and you say to yourself, well, wait a minute, nothing is going well on the outside. This can't be right. And what you really end up realizing is you're investing in 500 of the top companies in the United States who have lines to credit and all these different things. And my point of it is that as time goes on and technology becomes more and more part of what we do and automation becomes more and more what we do, I believe the reflection of the markets and public company health versus what we see in society are going to look very different again. It's going to continue this separation, you will, of companies doing very well and being profitable versus what we see around us are going to continue to change and continue to change. And it's always good to remind yourself that when you invest, what are you actually investing in versus what are you experiencing? And I think that was a big lesson coming out of last year that is going to stay true for this year and next year, where we see things happening in the market that may not reflect what we're seeing on the ground, but it's here to stay. The other thing I want to alert people to is that low rate problem. And we had touched on this a little bit last year, is that as the world gets healthier and as we get better, not only is it hard to get yield right now, but you're going to watch interest rates start going up naturally. When we had this call at first, I believe the 10-year treasury was at 0.68. And today that 10-year treasury is well over 1.2, I believe, or somewhere in and around there. I didn't see where it was as of close, but that almost doubled in a few months. And if you look at what rates do when they start rising historically to the markets, it creates additional volatility. So some of the things we look forward to, having a life that's a little more normal, being able to get back out and whatever, also have a hidden message of normalized monetary problems, the monetary policy that we could eventually go back and see the end of the 2018, if you will, come back. And just to remind people that getting out of the woods isn't necessarily the same as getting out of market volatility. Rather, some of the bad things you experience sometimes lead to better things in the future. Vice versa, as this gets better, that you should expect some volatility coming from areas where you may have not thought of that, specifically around the interest rate market and what we're seeing in the labor markets, where it's very hard to go back out and get those jobs, and yet productivity is through the roof. And so those are themes we're going to be really watching heavily this year and next year to see, as we evolve and come out of this, what really occurred and how is our society bifurcated and how can we find investment opportunities within those themes. And so that's what I'm really taking out of it, is that a lot of the things we were worried about are behind us, and the things that we see coming up in front of us are great, but may not necessarily lead to a great return. It's kind of counterintuitive, but sometimes it just happens to work that way. So kind of wanted to get your thought on that as well, Connor. How do you guys see that as rates move up, monetary policy normalizes? Does that have an effect?
Yeah, so first of all, we totally agree. Let me just pull up this chart for everyone on the screen, which is one we didn't get to, but I think it's really important. What you'll basically see here is what it's trying to show you is just maybe resetting the expectations around what do good returns feel like. And the challenge is we're coming off of, last year, which the S&P did, I think 16 or 17%. And then the previous year before that, it was even more than that. It was north of 30%. We think that, in our opinion, bonds on the left-hand side of the page, stocks on the right-hand side of the page, both of those asset classes need to be reset from a return standpoint. And there's ways to do more returns than this, but bonds, to Chris's point, are probably the most unattractive from a return standpoint. You can start to see that, in the 1980s, as I mentioned, when the 10-year treasury was yielding 12%, returns were really high. This black dot here at the bottom is basically telling you where we think for the next 10 years, bond investors should expect those returns to be. And unfortunately, it's sub 2% on an average annual year. Stock investors on the right-hand side of the page going forward, again, in the 2010s here, if you can see that yellow dot here that I'm trying to hover over, or the last decade that we just lived through, we averaged around 14% per year. Going forward, we unfortunately think that comes down to what we would call mid to high single digits, maybe 6 to 8% going forward. Those are not bad numbers. It's just a result of GDP has, of course, slowed down through this pandemic. And one of the challenges is markets are never pricing or never showing you what is happening today. They're starting to try to show you what's happening basically 6 to 12 to 18 months from today. And unfortunately, in our opinion, we would argue that some of the returns for the next year to 2 years have likely been taken, and we actually already experienced those last year. Again, that's not to say that we think stocks aren't a good investment and bonds are an awful investment. Really, it's just we all need to just reset our expectations around what should our portfolio likely do going forward. And again, I mentioned it before, but these tilts that we have in portfolio are becoming incredibly more important. So for example, I know working with Chris earlier this year, made a sizable move into emerging markets. Putting that into perspective, as of this morning, the S&P 500 is up about 3% on the year. Emerging markets is up right around 10% on the year. So going more global is one solution to this problem. Also having some of those strategic tilts into sectors like technology and healthcare. And of course, the overarching umbrella theme that I know Chris is a huge believer in is the ESG and sustainable. That to us is how we start to take maybe disappointing return numbers and move those higher without taking on too much more risk, in our opinion. So I think it's a great point. I think the expectation setting is likely the most important thing that we all can be doing going forward. But that's not to say that markets are an unattractive place to be going forward. It's just it's not going to be 30 to 40% like we felt in 2019, as an example.
Got it. Yeah, it's kind of what I'm thinking is the way I look at it is if last year felt weird when things were horrible, but the market started shooting up, they're going to feel just as weird when you look around and you're out and eating and everyone's doing better, but the markets aren't returning what you would think. Both can be true. And so that's part of what I wanted to get out today is the message. And that being said, we'll open it up for a minute or so to see if anyone on this webinar has any questions. If you do, you can just simply load them into the chat section. I'll hang on for a couple of minutes, see if anyone's got anything to say, and then if not, we'll conclude accordingly. And Connor, as always, thank you for all your help, the team putting this together today. To remind everyone on the call, this will also be up on our website in a week. You'll be able to see the full replay, and I'll be able to get you, is there a client version of this deck, Connor, that I can get out to people if they want to be able to go through it themselves?
Yeah, we absolutely can. So I'll be sure to follow up with you and make sure the presentation's available and maybe some one-pagers and good visuals as well, too. I'll send those all to you.
Great. All right. That sounds wonderful. I believe we don't have any questions coming in at this time. So I think what we'll do is we'll conclude this webinar. Again, thank you to Connor and the team at BlackRock for putting this together today. Oh, excuse me for a sec. I think we have one question coming in the chat. A question we got from a Mr. Conklin was, how do we propose to create value this year? to answer that question, the way we're going to be looking for value is in some of the markets that we've discussed this year. For example, value will be created in tech, healthcare, renewables, ESG metrics. Looking at the standard industries and standard portfolio creations this year, to your point, may not create a lot of value. What you need to do is you need to look under the water and really see what's going on in these companies. For example, when you look at what's happening with the weather in Texas right now and that the whole grid is failing or whatnot, when you actually look at it, there are some companies there that invested early on winterizing some of their gear, and a lot of companies didn't. When you look at where they are today and who's actually was thoughtful about the future, invested in their company, and are now growing it when their competitors aren't being able to do so, that's where we're looking for the value. And those clear ESG metrics are where you can uncover that sometimes. It's not just looking on top and seeing how the company's doing or its price to earnings, et cetera, but more so where have they redeployed their capital? Are they just buying back stock, or are they investing in their future? Are they adding new equipment, or are they actually refurbishing and retrofitting their current equipment? It's putting that all together that actually creates value in the year going forward, and that's what we'll look to do. So thank you for asking the question. Does anyone else have a question? Give it another minute. Okay. Well, I guess at this time we'll end the webinar, but if you do have any additional questions, feel free to reach out to myself, Richard, Jerome, or Michael. On behalf of Signet Strategic Wealth Management, we want to thank everyone for attending today and hope you have a nice, safe week. Thank you.